This is Greg Denweiler, and you're listening to another episode of the Dividend Mailbox, a monthly podcast about dividend growth. Our goal is to stuff your mailbox full of dividend checks and make each year's check larger than the last. Welcome to episode 28 of the Dividend Mailbox. As we mentioned last episode, we are going to look at the railroad industry and specifically Union Pacific. We are going to go into a fair amount of depth, and what you're going to see is how we personally have come to the conclusion that this is not a boring business, but it is a great long-term compound machine. I hope today gives you a sense of what it takes to build some confidence as far as how do you double your dividend in 10 years and then hopefully doubling the investment value. It does take effort, and you really do have to pay attention to what you're doing. So as we go through the business and look at the past stock performance, how it's currently valued, I think you're going to see that Union Pacific is a pretty compelling story. You really should keep an open mind on these things because these are really great cash flow compounding companies. When you look at the railroads, first of all, we have to start with the fact that there's just 6 major railroads out there. There are some smaller lines, but the big ones are Burlington Northern and Union Pacific basically compete with each other in the West. In the East, there's Norfolk Southern and CSX. And then sort of in the northern middle part of the country is Canadian Pacific and Canadian National. They both have lines that run down to the Gulf, but they don't have near as big of a presence in the U.S. They are here, but I'm not going to mention those really much at all. But one question you may have is, well, why did you pick Union Pacific? Well, fortunately, they all somewhat group together as far as long-term returns. There is a difference, but they don't deviate too much. But the dividend yields, the different companies have different policies as far as how they treat shareholders. A couple of them have pretty good dividend yields. Some of them are very low. We picked Union Pacific because the performance is similar to the others. It's somewhat in the middle of the pack, and the 2.5% dividend gives us our sweet spot where it gives you a chance to either live off the income or at the very minimum, it gives you a little bit of confidence when you're getting the cash flow in your account. But as you will see, they've all done well. Union Pacific is one of the oldest public companies on the New York Stock Exchange, and it's been paying a dividend for more than 100 years. So it definitely has a dividend culture. Just to give you kind of an overview, their revenue in 2002 was not quite $11 billion. 10 years later, 2012, it was up to about $19.5 billion. 5 years later, out into 2017, it was not quite $20 billion. So it didn't grow too much in that period. But by June of this year, it was up to almost $25 billion. So they really gotten, I hate to use this word, but back on track. Earnings have actually done much better. And part of this is just through really making the businesses more efficient. Earnings were 94 cents in 02, 335 in 2012, 508 in 17. So even though revenue didn't grow much, they did grow earnings by a fair amount. And then you get to the latest 12 months and they're up to almost $11 a share. So they've actually had some pretty decent earnings growth. When you look at the dividend, in 02, the dividend for Union Pacific was 20 cents. 10 years later, not quite $1. 2017 up to 225, and currently it's running at a rate of about $5.08. So looking back at the railroad business over a 20-year period, revenue has more than doubled, earnings have grown by more than 10 times, and the dividend has grown by almost 25 times. So there is definitely a growth component here. The railroads as a whole have really done a great job with cash flow management. And some of these pay out nice returns to shareholders. Looking at Union Pacific specifically, right now they're paying out about 45% of their earnings in a dividend. And that is basically the target of the company right now going forward. One of the things that Union Pacific has done in the last few decades is they've bought back shares. And this is going to come out in the story a little later, partly how they achieved that. But in 2002, they had 974 million shares out. By 2017, they were down to 814 million. And they got fairly aggressive after that point in the last 6 years to where now their share count is down to 609 million. So not only have they grown the dividend somewhat aggressively, they've actually bought back stock. So now let's look at the business of a railroad. What you're looking for are returns and that the business is profitable. The return on invested capital for Union Pacific was running around 5% in 2005. By 2010, it was up to 7.7%. In 2020, just slightly cracked 10%. Last year, they were up to 12.4%. So are these high-tech type numbers? No, but when you have a nice, strong, consistent cash flow and you're earning more than your cost of capital, that allows companies to return cash to shareholders and build investor wealth. And it's what's happened with the railroads. So now let's turn to just how profitable are these businesses. If you look at the gross profit margin, and simple explanation for that is what it costs to actually run the railroad every day directly related to what they do. In other words, they're running that train down the track. How much does it cost to actually run that train specifically? They have a gross profit margin of 44%, CSX 39%, Canadian Pacific 51%, Norfolk Southern 39%. Now, you have to keep in mind there is a little bit of leeway of how they allocate these expenses. So you have to be a little careful taking these numbers 100% as far as a comparison. When we go out to operating profits, that's where we're getting farther down where they're adding in admin expenses. And here's where I'm going to just make my point. Union Pacific, 38%, CSX, 39%, Canadian Pacific, 37%, Norfolk Southern, 37%. So as we get farther down the income statement, things really start to even out. Another thing, you look at the risk of the business longer term. For Union Pacific, coal represented 22% of their business 2 decades ago. A decade ago, it was 20%. Last year, it was 10%. So coal is one of their largest commodities that they deliver, but they're not extremely concentrated in any one area. They also are in transporting chemicals, petroleum, containers. They have a well-diversified product base. And whether you like coal or not, the good news is they're relying less on it. And from just a pure business standpoint, coal is not going to go away in the next 12 months. It probably will continue to decline over time. That's, in the long term, is a good thing. Another thing just to keep in mind, one of the huge issues for railroads is maintenance. And you want a decent maintenance program because what you don't want is derailments. Those can get extremely expensive, extremely fast. One of the ways to check on this or to get some feel whether you potentially have a problem is to look at CapEx and depreciation. We'll start with CapEx, and I'm just going to run these numbers for all of them. it's not important that you remember the numbers. It's just important that you kind of get the trend here. Union Pacific, 15% of their revenue, they spend in CapEx. CSX, 14.5%. Canadian Pacific, 18%. Norfolk Southern, 15%. So they're all basically in line there. And then when you look at depreciation, that's the expense that they're actually taking on the balance sheet. Looking at depreciation, Union Pacific spends 9 to 10% a year. Average CSX has been 10 or 11%. Canadian Pacific, 10%. Norfolk Southern, 9 to 11%. So they're all basically in the same range as far as what they invest in their business. But another thing here, which is actually a net positive, because you will see this in industries and in companies, when you look at CapEx, the actual expense compared to depreciation, what you really want to see is you want to see the asset base continually being updated and renewed. CapEx right now is around $3.6 billion for Union Pacific, and it's about $2.3 billion for depreciation expense. And in this case, for the last really more than a decade, CapEx has been running higher than depreciation, a little more than $1 billion higher. So they are out there constantly working on their asset base. If you're really going to dig deep into a company, it's a good thing to know. And if they're running a little bit newer asset base, that potentially is a positive for them. So what drives the dividend growth bus? Or maybe I should say train. Well, it's cash flow growth. That's the bottom line over time. In the last 10 years, Union Pacific has grown their continuing operating income by 77%, and over a 20-year period, 453%. Those are pretty attractive numbers. And in 2022, cash from operations were $9 billion. CapEx, they spent about $3.6 billion. The dividend was $3.2 billion. That leaves $2.2 billion left over that they can either buy back stock, raise the dividend, or they can pay down some of the debt. So, the business is relatively strong, but let's look at the required return that we need to double our dividend in the next decade. For 2023, currently they're paying $5.08. So in 2033, the dividend has to grow to $10.16. Well, the good news, it's nice to see this starting out. They are already earning $10. But of course, they're not going to pay out everything in a dividend, at least not on a sustainable basis. Now, it's not unusual for a company to pay out more than what they earn over a short period of time because of a recession or some one-off event. But going back to Union Pacific, if they're going to pay a $10.16 dividend and they continue to maintain that 45% payout ratio, that means that Union Pacific is going to have earnings of $22.50. What that means is earnings are going to need to go up 2 times. Well, just as a point of reference, earnings have gone up in the last 10 years by 3 times. So it seems reasonable to assume that Union Pacific can grow their earnings by 7% or double them in the next 10 years. When we get a double in the dividend growth and the stock yields at the end of that time period 2.5% or even slightly higher, we will have achieved about 110% total return, which is our hurdle rate, and that does not count compounding. Now, finally, as far as business overview, we're going to look at debt because this is a piece of the story for Union Pacific. It has $35 billion of debt. It has the highest debt of all the railroads, and it's 2.5 times equity. Well, one of the things you have to remember is that a lot of it has come from share buybacks. From 2018 to 2023, They basically spent $25 billion in buybacks. About half of that, they had to use debt. And that was $13 billion of additional debt they raised just for share buybacks. One thing going forward, the share buyback, at least for the next few years, is probably going to slow down considerably. But I don't think we really need to worry about that because we can still get the dividend growth without it. So $28 billion is greater than 5 years, and their rates average between 2.2 to 7.1%. They have $1 billion that's out in 2072, which is virtually 50 years from now, and their interest rate on that is 3.8%. Union Pacific has about 25% of their debt rolling over in 5 years. That's a little bit of a risk because going into a higher interest rate market, it's going to lead to more interest costs. Well, just another quick back of the envelope calculation. 25% of their debt is basically $7 billion in the next 5 years. If that cost goes up by 3%, it means that they're going to pay an extra $210 million of interest costs. Well, when you're looking at $2.2 billion of excess cash flow over and above CapEx and the dividend, that's just 10%. I think you can actually spend that to a positive that they've locked in low rates, that we may not ever see those rates that low again. And for Union Pacific, they earn 7.5 times more than what their interest expenses are. And you have $2.2 billion of excess cash flow, which is extremely likely to grow over time. You potentially can retire that debt in 10 years, maybe even faster, depending on how fast your cash flow grows. So we are very cautious about debt, but because of the predictability of the business and just the core dependence of the economy on railroads, and they have strong cash flow here, I'm not so concerned about it. They have huge moats. Nobody can go out and build a track really across the country now. I mean, it's for all intents and purposes impossible. And just to confirm how predictable these businesses are, one of the railroads has a bond that matures in 2170. You kind of have to step back and wrap your head around that one. What business is there that in more than the last century, the business is basically still the same, and it potentially is going to be a version of the same business over 100 years going forward? Unfortunately, there's a lot of numbers out here, but part of what we're trying to do is to show when you want sustainable dividend growth, you have to really look at where it's going to come from and how likely you're going to get it. So, in summary, what we have here is a company that generates enough free cash flow to pay for CapEx to maintain the business, is more than enough to grow the dividend, pay down debt, and even buy back some stock if they choose to. The revenue and earnings of Union Pacific should, at the minimum, grow at least as well as the economy does. And I think this is one that you could safely call a GDP plus company because they've shown the ability to grow faster in the past through efficiency and productivity gains. And I hope that one of the big takeaways that you get from what we've just gone over is that these businesses are stable, they're predictable. For the most part, they run somewhat similar together because really they're all doing virtually the same thing. There's not too much difference between them. But this is one of those situations that it's not too difficult to figure out how we can connect the dots over the next decade to potentially getting at least a double on our dividend, and the stock price should follow. There can always be an outside event that changes the picture, but you don't need too many things to go right, really just more of what they're doing. It's an attractive industry as a whole, and I think it just makes sense to have one of them, at least in your portfolio. And it's probably why Berkshire Hathaway does. But before we move to the next section, I would like to mention that we do plan on building an investor presentation for Union Pacific. I am not going to promise a timeline yet, but it is our goal to do it. And one of the ways that you can get a copy is join our newsletter. I try to, realize that when you're listening to something, you cannot keep all these numbers straight. So we do intend to put something out there so that if you want to review it, you can. Once we put it together, we'll send it out to the newsletter list and also link it to the show notes. But anyway, now we're going to move to probably what all of you have been waiting for, and that's stock performance. We've talked about the second decade effect in past podcasts and the power of compounding. Well, here is the example living out in real life. When you look at these railroads, in the last 30 years, the total return has been, for Union Pacific, it's up 2,300%. For CSX, it's up 2,140%. For Canadian Pacific, it's up 2,430%. Norfolk Southern is 1,530%. If you just would have invested in the S&P 500, you're up 470%. These things outperform the stock market by a fairly wide margin. And if you say, well, okay, I want something more exciting. I want technology. I want those big gains. Okay, well, let's look at the last 20 years. Union Pacific had 20% plus gains in 11 of those 20 years. And in 8 of those years, it showed 30+% gains. Maybe it's not Apple or Microsoft or Amazon, but in my book, with the consistency and the predictability, it's a pretty close second. And if you look at stock performance in a recession, I can virtually guarantee you here the railroads beat it compared to the S&P 500, which in both 01 and 08 dropped by 50% or slightly more. So if you look at stock prices from the beginning to the end of past recessions in 1973 to 75, Union Pacific was down. The stock price was down 7%. In 1980, it was up 21%. 81 to 82, it was down 29%. In 90 to 91, it was down 2%. In 2001, it was down 2%. In 2007 to 2009, it was down 17%. And in February to April of 2020, the stock was basically flat. So they tend to hold up fairly well in recessions. Now let's look at valuation. The 10-year average price to free cash flow is around 25, and now it's 22.6. So it's a little cheaper than its 10-year average, not a lot. Price to sales at 5 is about the low since 2020. It's a little cheaper, but not by a lot. PE is around 19 to 20, depending on earnings this year, and that's roughly where the market is, maybe slightly cheaper. So it's not a fire sale. It's arguably trading just a little bit below what we might call fair value. But I think you've got better risk reward and you've definitely had better performance in the last few decades. You're paying about the same price for what previously has performed better. I think it's definitely worth considering at this point and looking at chances to build a position over time. But if you're still a little suspect, should I own a railroad? Now we're going to turn to Burlington Northern, BNSF. It is owned by Berkshire. They bought it back in 2009. And you're going to be able to see just how strong of a return that Berkshire Hathaway has generated from it. Just looking at the business in the big picture, coal represents 16% of their business in 2022. So it's actually has a little bit more business risk from that standpoint. Revenue in 2022 was $25.8 billion, roughly the same size as Union Pacific. Operating income in 2022 was $8.6 billion, or a 33% operating margin. That is, you may remember, a little bit below the other railroads, which were up in the high 30s. So actually, Burlington Northern is not quite as profitable. Return on invested capital in 2022 was a little under 8%. That compared to Union Pacific, which is at about 12.5%, it's not as profitable. And when you look at CapEx, is this a big warning flag? I doubt you can go that far. But CapEx, they spent 13% in 2022 versus the other railroads were really up around 15%. So they're not spending quite as much keeping the railroad maintained. Here's where it gets kind of interesting. The operating cash flow for Burlington Northern is $8.7 billion. They spent $3.4 billion in CapEx. That left them with a free cash flow of $5.3 billion. They made a member distribution, which was to Berkshire Hathaway for $5 billion. They basically paid out most all their free cash flow, which is what happens when you own the whole company. Well, you're probably thinking, geez, I wish I could do what Warren Buffett does. I'd be rich too. Well, let's look at what he did. In November of 2009, he spent $34 billion to buy Burlington Northern. I just told you that they took a distribution last year of $5 billion. That's a yield on his cost of 15%. Now, let's look at Union Pacific. You could have bought the stock in November of 2009 for $30 a share. If you look at the current dividend of $5.08, that's a 17% yield based on if you would have purchased the stock at $30 back in November of 2009. Last I checked, 17 is bigger than 15. You could have done exactly what Warren Buffett did, and right now you can buy a railroad that appears to be a little bit better run, more efficient, and a little bit more profitable than what Warren Buffett has. But then you have to ask, why does he own it? I think the answer is pretty simple. Number one, he's got 15% cash flow coming out. He's letting the thing run, which is what he does with his investments. And here's the biggest picture. You may remember I mentioned, sort of in passing, that there is one of the railroads that has a bond out there in 2170 is when it's going to mature. Warren Buffett, I think, looks at this business, which is what he's famous for doing. He loves the predictable cash flow and reinvesting it. And he's probably extremely confident that it's going to be around for decades to come. You have almost zero risk of any major disruptions. They only compete really in any significant way. There's two companies in each region, basically monopoly businesses. And the only significant risk you have, there is derailment risk that is out there that can affect the business model, especially short term. I would argue there's probably a little bit of political risk, although there's no way of telling and there's no prediction that this is what's going to happen. But you could possibly say, well, there'll be some kind of a carbon tax. There'll be some kind of a tax on diesel fuel. But the bottom line is every company has some form of risk to it. So if you're not quite convinced yet and you can't quite figure out, why do I want to own one of these boring businesses? How is the company really going to grow? Well, it's really just as simple as GDP continues to grow and there's inflation. Prices over time go up. Railroads raise their prices. And I think there are a few catalysts for Union Pacific, which will be a positive here in the future. They just brought in a new CEO in August of this year, Jim Vena. He went to work for Union Pacific 5 years ago and joined as chief operating officer, but he comes from a 40-year background at Canadian National Railroad. He's known for the precision railroading method, basically tries to target increased capacity, reduced dwell time, cost savings, enhanced service reliability, and it does appear Jim has a pretty good track record of actually executing. And then, not that I'm an AI expert, but it's not too hard to start to imagine where scheduling gets much more efficient with AI. They can reduce dwell time and potentially put more cars on the track. It doesn't seem like a very big reach to figure out how you could get some real productivity gains with technology. The one thing we haven't talked about, trucks versus trains. Trucks are much more versatile. They go to the last mile, definitely. But the problem with trucks is they're more expensive. Trains are supposed to move at the rate of 5.1 cents per mile, and a truck costs 15.6 cents a mile to ship on. So there's a pretty big cost advantage. And also, by default, they are much cleaner. It just takes a lot less energy to drive the same weight. If you get a new energy source, our transportation system going to electric or going to hydrogen or whatever else that may come up, you just have to think that that same technology would go straight to the railroads. And then you think about more production coming back over because of fear of China and Russia. And we got caught big in 2020 with supply chain problems. If they actually do move a little bit more production back to the U.S., that is just potentially a long-term plus for trains. And I'm going to throw out a challenge here. And if you can meet the challenge, you're going to get a free Dividend mailbox Yeti mug. And the challenge is, which industry can you name that has more staying power, has more predictability, and that you can say with some confidence 50 years from now, it's still going to be around. It's still going to be a key part of the American economy. I can't imagine anything else that can compete on that level besides railroads. So, in summary, we are looking at it. We fully intend to build a position in it. We may have a position by the time you listen to this. The other thing that's extremely important, this is one idea. This is really just an overview of our process of going through how we look at something. This is in more detail than we've done anything in the past. The takeaway is these are great long-term compounding tools. And it's how well they manage their balance sheet, allocate their capital, and what they return to shareholders. That is really what makes the railroads a compelling story. And I have to admit that I really haven't looked at them in the past because my general impression was, without knowing too much about them, it's pretty hard to connect the dots that I'm going to make any real money here. But in fact, these are some of the better performing businesses in the last several decades. Really, in the end, it's not what the company does is what's so important. It's how well they do it. If you enjoyed today's podcast, please leave us a review and subscribe. If you would like more information regarding dividend growth or our investment strategy, please visit growmydollar.com. There you will find previous episodes and also our monthly newsletter. If you have any questions or anything to add to today's episode, please email Ethan, ETHAN, at growmydollar.com. Past performance does not guarantee future results. Every investor should consider whether an investment strategy is right for them and all the risk involved. Stocks, including dividend stocks, are volatile and can lose money. Denweiler Capital Management may or may not have positions in the publicly traded companies mentioned herein.